What's going on, you guys? Making a video covering the strategy overall of, the break and retest using key levels that I use every day and that I've used swing trading and now I'm using it on the day trading time frame. So we're looking at the ES chart for examples here on the 2 minute, and this is already all charted out with the levels that I used, for today's trading session, just to make it easier for explanations, just to have them already all there. But we'll cover why those are key levels and how I identify key levels in the pre-market. So we're going to assume all of this here past, like 9 a.m. didn't happen yet, and just pretend it's like a pre-market analysis that I do every day. So looking at that, how do we identify key levels? Where do we start? And what data points do we want to be looking at? So um, for Tuesday, the first thing I would want to look at is the pre-market low and the pre-market high. So we can see here market closed on Monday there at 5 p.m. So anything to the right of that, we can see our pre-market low was right here at the bottom of this wick. Now, I didn't put my level right at the actual pre-market low because we want to look in the past and we want to look, is there a level or a price where very close near our pre-market low, but maybe not exactly at it, where we're seeing strong reactions. So you can see several reactions here slightly above. So instead of putting it a little bit further low, I raised it up a bit. And then I also noticed to the left in the past, look at these huge strong reactions from this level that price has had numerous times to the upside and to the downside. So that was clear as day to me that that needed to be a key level. So we threw that on the chart. And then the next spot would be pre-market high. So if we're looking to the right of here, this would be our pre-market high. And again, we don't always just want to throw our level where the pre-market high is. A lot of times that's okay, even if it is a wick. But in this situation, I happen to notice something, and this will just come with experience as well. But I noticed that if we ignore the wick and we look at the body close, our level would be right here. And then I also noticed at Monday's previous day high, so not pre-market, but the previous day high, because that was during the trading session right there, almost perfectly aligned with the body close of our pre-market high. So it made a lot more sense to me to throw our level there instead of up here, because we didn't have any other data points lining up with it, which isn't a problem in itself. But the fact that the body close lined up with the previous day highs, it just made more sense to put the key level there. So I hope that makes sense, but that's what I mean by we don't just throw it right on the previous or the pre-market high. We use context clues and experience to identify the exact key level that we want to use. So after you got pre-market high, pre-market low, you kind of just want to work your way back. So after that, it would be, the Monday low. So if we look here, we can see that during the trading session, which would be after 9:30, would be right here. So this was our previous day low. And again, I noticed slightly above that, we had price reacting in the past, boom, big strong bounce, and after that, big strong bounce slightly above it. So we went ahead and decided to put the level there, and it doesn't really make sense to put two levels that close to each other. So I went ahead and just went with the more clear key level there. And then when it came to the previous day high, we can see that that was already covered with how it aligned with our pre-market high on Tuesday. So that was already covered, and then that leads us to our pre-market on Monday. So pre-market high on Monday. You notice if we drag that a little bit to the left, we had another reaction there. And then moving forward, we had another reaction, bounce, etc. And then we see yet another bounce in the pre-market. So that, again, very clear level, and it just happened to be right at the pre-market high. So that happens a lot too, where, okay, put it right at the pre-market high. Does that make sense? Boom, yeah, it definitely makes sense right at the pre-market high. So that's an example of putting it right at the data point. And then after that, I mean, we have a pretty wide range here with these four levels. So nothing above, because we haven't been this high up in previous days. So there's nothing really above this level. So we would just go further back in time to cover levels to the downside. And obviously it goes on, but we don't need to get super repetitive. But we can see here after Monday, we would be looking at the pre-market lows. So that was the, during the day lows. You can see that's in the pre-market and it lined up with it. But the actual pre-market low, because this is Friday's close, we're looking to the right, would be right here. And again, just above it is where we're having several reactions, so it made more sense to throw it there. So that's our pre-market low. And then our pre-market high was already covered here. So we had a huge gap from, if this wasn't there, we would have a huge gap. So let's just delete this for now. I noticed, and when we have a huge gap like that and we've covered all our data points, it's okay to add in an additional key level if it's really clear on the chart. And you can see here, the top of that wick lines up beautifully with the huge bounce there and then another minor rejection there. So that's why I threw that key level in. So it's okay to throw key levels outside of those data points, as long as it's very clear and it's only because there's a huge gap in our levels and there's not historic data at that level either. So if we had, Friday's close, Friday data point up here, it would make a lot more sense to use that instead of this, but we don't. So yeah, that's how I identify the key levels that I want to be playing off of in the market. When it comes to the actual break and retest itself, we have an example from today. It wasn't an actual trade because it pushed too far away, but we can still cover the strategy itself and how we execute our trades. So for this one, we're looking at the no trade zone. So my no trade zone is whatever channel price is in going into market open. So we're in between these two levels. So I made it clear to myself, I'm not going to place any trades until we break out of the current channel. So we stayed in that channel until around 9:42. So not too long after market open, we got a break and close above it. And that's decently well above the level. So I consider that a clear break. And then we got the retest immediately after. It kind of went below it, but it wicked, so that's fine. And then we can see the next, excuse me, the next few candles all showed that price was holding that level. So on any of these candles, all I was waiting for was a strong bullish close that wasn't too far away from the zone, and I was getting in. And the way I draw my zones is I just put it covering a very small portion of it, and then I want to extend the zone out about the distance of the zone. So you can see here, this is about the size of our key level. So that's how I draw my zones. And that's just to let me know the absolute furthest from the zone that I want to enter. If price closed a strong bullish candle right around here, I'm perfectly fine with that as long as it's a sizable candle and we were holding as we saw. I would simply just drag my zone a little bit further down, cover a little bit more of our key level, and adjust our targets as such. But I always know exactly how much I'm risking going into a trade when I have my zone already on. I might have to adjust where I put my stop, but I always know going into a trade exactly how much I'm going to risk. So that's what I love about the strategy as well. And you can see the candle closed just way too far away from the zone that I wanted to enter in. So I did not get in this trade. The stop loss would have to be way too large, and then we need a huge move just to get a 2-to-1. It's all downhill if you're too far away from the key level and you're entering. So you never want to do that. You never get FOMO. You just let the trade go and you wait for the next opportunity. So that's what we did today. No trades at all. And yeah, we stuck to the strategy. When it comes to scaling, pretty simple with that. I like to take off 25% of my original position size at around 1.25 risk to reward. So that would be right around this point here. And that's just so we take an enormous, or not an enormous, but we cut our risk damn near in half if price were to immediately reverse after that point and stop us out. And we don't have to move our stop. So we're giving, our position plenty of room to breathe, and we're also reducing our risk. So moving your stop loss makes it really easy to get stopped out on a pullback. By doing this, you avoid that and you're able to cut, your risk majorly. And then once I hit 2 to 1, I go ahead and take another 60% off. So at that point, we're 85% of our position we're out of. We are averaging around a 1.5 risk to reward on this play, locked in, move the stop to break even, and then just wait until the next key level and see how we react to it. If we reject, go ahead and get out. If we are able to turn it into support, um, and continue, then we can just move our stop loss at the bottom of the next key level and just continue riding the trend. So that's all going to come down to, personal management when it comes to runners, but that's how I like to address it. And if you have any questions about the break and retest strategy or any technical, any specifics about the technicals, please leave them down below. But yeah, that's a quick explanation and breakdown of what I look for on the day-to-day basis.